Okay, let's dive into this. Imagine a financial world with absolutely zero paperwork, no waiting around for a manager's approval, and honestly, no such thing as office hours. We're talking about a world where the gates to finance are wide open 24 hours a day, 7 days a week.
Seriously, what if you could borrow, earn interest, and swap money without ever once having to talk to a bank? To a lot of us, it sounds completely impossible, right? I mean, it goes against literally everything we've been taught about how money moves. But that is exactly what decentralized finance, or DeFi for short, is trying to achieve. In this explainer, we're going to break down exactly what this is, how it actually functions in reality, and why millions of people are already bypassing traditional institutions to use it.
All right, Section 1. What is DeFi?
At its core, rather than being built in towering skyscrapers on Wall Street or in corporate bank headquarters, this entirely new ecosystem of financial services is built on blockchains, predominantly on the Ethereum network. You know how in the traditional world, a bank acts as a gatekeeper to manually approve your transactions? Well, DeFi replaces those traditional banks with automated smart contracts. They do all the heavy lifting and decision-making, allowing everyday people like you and me to use money without relying on centralized institutions.
So what exactly is a smart contract? Simply put, it's just a piece of code that automatically follows a set of predefined rules. Think of them as the invisible, incorruptible rule enforcers of the blockchain. There's no human sitting there making a subjective judgment call. The code simply executes exactly what it's been programmed to do the second certain conditions are met.
And this brilliantly illustrates the fundamental difference between a human cashier and a vending machine. With a cashier, you've got human interaction, right? A potential bottleneck. Someone who has to physically take your money, process the transaction, and hand you a product. But a vending machine? You just insert your money, press a button, and the machine automatically drops your snack. No cashier needed whatsoever. Well, DeFi works in a remarkably similar way. The blockchain automatically executes the rules, just like that vending machine dispensing your snack.
Moving on to Section 2, how DeFi actually works. Let's put some faces to this process to really humanize it. Imagine Sarah wants to lend out her crypto to earn a little yield. Instead of walking into a local bank branch and handing cash to a teller for a savings account, in Step 1, she deposits her assets directly into a DeFi lending platform. At the exact same time, in Step 2, Alex requests a loan. In Step 3, that smart contract we talked about automatically connects them. Sarah earns interest on her deposit, Alex gets his loan, and finally, in Step 4, the blockchain transparently records the entire transaction for the whole world to see. Notice the key takeaway here. Not a single bank employee was involved in this entire financial exchange.
Section 3, real DeFi examples.
Now, these aren't just theoretical ideas. These are practical, everyday applications that millions of users are interacting with right now. One of the absolute most popular activities in the DeFi space is swapping tokens. Say you own some Ethereum or ETH, but you want a stablecoin like USDC. Instead of using a centralized exchange where some company holds your funds, you can use a decentralized exchange like Uniswap. The smart contract basically exchanges your tokens directly from your own wallet. You never have to give up custody of your assets to a third party during the trade. Another massive use case is lending and borrowing. Platforms like Aave allow users to lend their crypto out to earn interest or to borrow assets by providing collateral. And it happens entirely through smart contracts. There's no massive stack of bank paperwork to fill out. There's no waiting around for a credit check. It's just code automatically verifying the collateral and immediately executing the loan.
So, the crucial point is Section 4, why people use DeFi.
DeFi offers some major, honestly disruptive advantages. First off, it is completely permissionless. To get started, anyone, anywhere in the world literally just needs an internet connection and a crypto wallet. No gatekeepers to deny you access. Second, it's available 24 hours a day, which is a huge contrast to traditional banks that close up shop for the weekend and holidays. Third, every single transaction is totally transparent because it's permanently recorded on the public blockchain. And finally, users maintain total control of their own assets instead of handing them over to a centralized bank to hold on their behalf.
But of course, it's not all sunshine and rainbows. Section 5, the risks of DeFi.
Because this entire system relies on code, well, if those smart contracts contain bugs, things can break. Hackers are constantly out there prowling for vulnerabilities in public code to exploit. Plus, there are definitely outright scam projects designed to trick users. But a major, very sobering reality of the blockchain itself is that transactions are usually irreversible. This means if you simply send your funds to the wrong address, it can be a costly, permanent mistake. There is no customer service 1-800 number you can call to get a refund.
Let's move to Section 6, TradFi versus DeFi,
and see how this builds our understanding of the two systems.
Think of traditional finance, or TradFi, kind of like ordering food at a restaurant. A waiter takes your order, a manager oversees the kitchen, and someone delivers the food to your table. Human intermediaries are heavily involved at literally every single step. DeFi, on the other hand, is much more like cooking with a highly advanced automated machine that follows exact instructions every single time. No waiter, no manager, just strict rules written directly into code.
To summarize the core takeaway here, removing those human intermediaries means you, the user, hold much greater responsibility for your own security. Experienced users know they have to always research and use trusted platforms before they even think about connecting their wallet. You really have to meticulously double-check every single transaction. And the absolute golden rule of this entire space: never, ever share your recovery phrase with anyone.
Well, we've covered a lot of incredible ground today. We've seen how smart contracts step up to handle complex transactions, allowing you to lend, borrow, and swap directly from your crypto wallet without needing anyone's permission. We've explored the amazing 24/7 efficiency of it all, but also the very real risks of irreversible transactions and software bugs. But after learning exactly how this automated, code-driven system works, it leaves us with one fundamental question to chew on. Would you trust a smart contract more than a bank? It's a fascinating paradigm shift, for sure, and definitely one to watch as this technology continues to evolve. Thanks for joining me on this explainer, and keep learning.